Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. There's really only one story today, that would be tariffs. Markets plunging after President Trump unveiled his reciprocal tariff plan on Wednesday, putting several industries at the center of his trade war. The Dow dropped nearly 1,700 points. The Nasdaq shed over 1,000, and the S&P re-entered correction territory, losing almost 300. It was the worst day for both the S&P and the Nasdaq since 2020. We're going to break down what the new measures mean for the economy at large, plus a few individual sectors. Well, as President Trump's tariffs continue to send shockwaves through the markets, autos are getting hit particularly hard with 25% tariffs on all auto imports, in addition to reciprocal tariffs, all of which are taking effect today. For more, we're bringing in Kevin Roberts, Director of Industry Insights and Analytics at Car Gurus. Kevin, it's good to see you. So let's dig right into this, Kevin. You got 25% tariffs on autos and auto parts from outside the U.S. So for these companies, their costs are going up. You can't eat all of that, so you're going to pass some of that along to Kevin and Josh. I mean, one question I have, Kevin, is how much you think prices could be going up here. I did see some analysts saying, listen, they're ballparking, maybe 5,000 to even 10,000 for the typical car. But does that dovetail with what you're thinking?
Yeah, so we put out some recent analysis yesterday and just kind of looking at kind of average prices across the board. In the U.S., ended March around 49,500. Based on our analysis, average prices across the board can increase by about $3,000, getting close to $53,000. But it's important to keep in mind it's going to be highly dependent on where those vehicles are coming from. As you mentioned, there's certain kind of carve-outs for U.S. built vehicles, USMCA compliant vehicles, and then vehicles coming from non-North America are going to have very different rates. So that's kind of the blended average, what we're looking at. But, European cars might have higher prices compared to vehicles coming from Canada.
And broadly, Kevin, what has affordability been like even before these tariffs?
Yeah, so it's a really unfortunate time for these tariffs to be coming into the marketplace. Affordability was already an issue in the new vehicle market, and we think tariffs are just going to further exacerbate this. So that analysis I was just talking about, we're expecting to see potentially 42% decline in vehicles priced under $30,000 and a 15% increase in vehicles priced over $50,000. So it's important to keep in mind that affordability has already been kind of a downward trend. In Q1 2020, about 37% of vehicles were priced under $30,000. And now, at the end of this past quarter, it was only about 13%. So affordability has already been an issue, and tariffs are likely to further exacerbate that affordability issue for consumers.
So listen, as affordability already tough, now as prices go up, what does that mean for demand, Kevin? I saw analysts at Wedbush this morning, they were telling clients they're estimating demand destruction of 15 to 20% in 2025 for new auto purchases. What do you make of that kind of estimate?
So we've already been kind of anticipating kind of declines in top market growth for new vehicles kind of going forward in a post-COVID environment. The market generally was like 17.5 million pre-COVID. That increase in vehicle prices we're already looking at, we already thought potentially took about 1.5 million annual consumers out of the marketplace. It's still a little too early to say how demand is going to shake out. In fact, if we look at kind of sales rates post the U.S. auto tariff announcement on March 26th, sales rates are really hot right now, as consumers are likely looking to get ahead of those tariffs and kind of take advantage of that pre-tariff inventory. So it's a little bit too early to say right now. We're keeping an eye on what the modeling might look like. But right now, market is exceedingly hot for new vehicle sales.
Kevin, I'm curious what you think, these car companies, these car manufacturers, how they'll react, how they'll respond. Already I'm seeing, reports, headlines, Stellantis, Kevin, pausing some production in Mexico and Canada, Volkswagen apparently halting rail shipments from Mexico, Ford is going to be offering employee pricing. What do you make of these moves, Kevin?
Yeah, so it's pretty interesting. It's an automaker by automaker kind of response to what we're seeing in the marketplace right now. So again, certain vehicles, particularly vehicles that may already have a large amount of supply in the U.S. market, we're seeing production delays of those vehicles, which could make sense in the marketplace. Again, kind of wait and see. And then other automakers, you mentioned Ford, they already have 80+% of their vehicles are built in the U.S. And so they may be able to kind of lean into this. So it's going to be an automaker by automaker situation where your vehicles are produced. could be opportunities or challenges, depending on where that production is located.
Kevin, as always, great to have you on the show and help us think through all these dynamics. Appreciate it.
Absolutely, my pleasure.
Stick around, much more Ask for a Trend right on the other side. Trump's tariffs pummel markets as the Nasdaq and the S&P 500 see their biggest one-day loss since 2020. Yahoo Finance Josh Schaefer joins us now with the trading day takeaways.
Josh, it was a brutal day in the stock market. There's no other way to put it. And what I want to take a look at here is just sort of run through exactly what we saw in some key stats as you were just listing there. So you did mention Nasdaq Composite saw its worst day since 2020. So I'll move to an intraday just so we get that nice round number. Down almost 6% for the Nasdaq Composite. Then you take a look at the S&P 500. That fell almost 5% today. Then we go over to the Dow. The Dow fell nearly 1,700 points today. This is the fifth biggest point drop we have seen for the Dow Jones Industrial Average. Now, I think if you zoom out to a 3-day on some of these, what you're going to see here, remember, stocks have been up a little bit coming into the tariff announcement. What this tells you, markets had no idea this was coming, right? Market investors were not positioned for the level of tariffs that we got from Trump. I think even perhaps you could argue investors were maybe positioned for, okay, we get a little certainty. Maybe we get a little,
to your point, they were firming up into that.
Maybe we get a little bit of a bounce, right? And that is just simply not what happened. I want to look too at exactly where we saw a lot of the selling. It is, of course, where we've seen a lot of the selling over the last month. Look at your Magnificent Seven names. Apple down over 9%, Amazon also down about 9%, Meta 9%. This cohort, Josh, lost about $1 trillion in market cap today alone. It was just a brutal, brutal sell-off. You see a little bit of green, some safety plays like a Costco, but generally speaking, there were not a lot of places to hide in this market today.
So today, the strategists start pumping out their notes. They're telling clients, what to make of this, how to navigate this, what to do with their money. Did you hear anybody, did you see anybody saying, buy this, move in, buy this, the worst is in the rearview mirror?
There is a lot more people talking about how much further stocks could fall than come in and buy the dip right now. And I think that's a clear shift of what we've seen from strategists really over the past 18 months at this point, right? There's been plenty of little scares in this market where people have said, you know what, let's flip this to a 52-week high so you can see how far off these stocks are from 52-week highs. There's been plenty of times where people say NVIDIA 30% off a 52-week high. I like it here. Let's jump in and start buying. Let's start buying some of these Mag 7 names off over 20% from their all-time highs. That crowd is just quiet right now. Really what the strategist conversation is I'm wondering how close we're getting to my bear case. I'm starting to think maybe the S&P 500 finishes the year around 5,500 where we are right now. The key to that being, Josh, what do we hear from other countries and how do these negotiations go?
Yeah, do they negotiate or retaliate?
Strategists essentially saying what we learn about these negotiations over the next week could be the key for whether we have more downside or potentially there is room to find a bottom here.
All right, Schaefer, bullet point number 2.
Bullet point number 2, Josh, is really about what this tariff discussion is sort of centering around, right? So tariffs are expected to raise inflation, lower growth. What economists are arguing is that growth fears are going to be the bigger part of this story. So you heard Chair Powell talk about the inflation impacts of this perhaps being transitory, meaning there'll be a one-time pass-through. Well, if growth starts to lag, growth doesn't just fall for a quarter and then come right back up, right? If we start rolling into some sort of recession, that would continue. So what you saw play out today in markets, we now have investors pricing about 4 interest rate cuts from the Fed. This is up from about 2 or 3. And again, not really for good reasons. If the Fed is cutting because the economy is slowing, that's not typically a welcome sign for stocks. So again, that's just where people feel like this could be headed. We got the tariff announcements yesterday. It's not like the entire economy changed this morning. We still need a lot of this to play out and start seeing more data. But it's clear in the last 24 hours, economists feel like the risks of recession have certainly.
And you look at that 10-year, that would seem to suggest recession fears outweighing inflation
down 15
fears.
basis points today to 4%.
Tomorrow, jobs report, let's end there. What do you expect?
Yeah, so the jobs report for March, again, isn't supposed to include a lot of the things we just discussed. So we're looking for about consensus 140,000 payrolls added, unemployment rate flat at 4.1%. Again, I think the big fear now would be if the unemployment rate were to start ticking up, before we even have a lot of the impacts from this Trump policy, that would be a concern for markets, and we just showed how growth fears are weighing on the market. I do not think a below consensus report tomorrow is going to be a good sign for the market.
Cooling but not crashing, that's been the mantra for the labor market, but now to your point with all this uncertainty,
It's been the steady eddy of the economic data thus far, so we'll have to see if it holds up again.
We shall. Thank you, Josh. Stick around. Much more Ask You for a Trend that's right on the other side. Intel and Taiwan Semiconductor reportedly reaching a tentative deal on chip manufacturing. That's according to a report from The Information. Intel shares jumping on that news. The report saying the two companies have agreed to form a joint venture with other U.S. semiconductor firms that would operate Intel's semiconductor manufacturing facilities. Taiwan Semi would take a 20% stake in the new organization as part of the deal, and Intel and the other investors would control the rest. In exchange, Taiwan Semiconductor would provide Intel with information about how to build its chips, as well as provide training assistance for Intel's personnel. The Trump administration has been pushing the companies to move forward together and is keen on shoring up the U.S.'s chip manufacturing capacity. TSMC has already pledged $100 billion in U.S.-based chips manufacturing. Chip makers managed to escape specific tariffs in President Trump's new levies on imports to the U.S., but those stocks still got slammed today, along with the broader market. Joining me now is Gil Luria, D.A. Davidson Managing Director. Gil, always good to see you. So I'm looking, Gil, here at the SMH, the ETF that tracks the chips. It's down about 9% in today's trade, Gil, so it gets slammed. How are you thinking, Gil, about what these Trump tariffs do mean broadly for the chips, at least near to intermediate term? How are you thinking through it?
Yeah, there's several levels of impact. What we already know, there's going to be broad 10% tariffs on everything. So I think saying that there's going to be 10% price increases across the board or cost increases across the board is fair. Not a coincidence that stocks were down that much. But then there's the next level effect. So the next one is the reason semiconductors were excluded from the reciprocal tariffs wasn't that we're not going to tax them. It was that there's going to be specific regime for regulating and tariff around semiconductors that we don't know about yet. So we will learn about it. It is very likely to include China and restrictions on China. So we will find out about those, and those will probably make it even worse. And then the next order effect is what an overall slowdown in the economy is going to do to demand. Let's not forget that when Microsoft, Google, Amazon, and Meta embarked on this journey to do this huge build out of data centers, their core businesses were doing very well and generating a tremendous amount of cash. And they were willing to make this speculative bet that AI is going to generate fantastic returns in the next several years. If the global economy weakens, demand weakens, their core products have less cash to produce, they're less likely to want to be on an aggressive path towards building data centers that are only going to pay off many years in the future. And that is going to have an impact on the semiconductor space as well. So I think those are the levels of thinking that we need to have right now as we find out what's next.
So the data center side, Gil, but then are you also saying, just to make sure I'm understanding you right, that we also have to be concerned about all the products that chips go into on the consumer side too, smartphones, PCs, autos, because they are getting tariffs. So as those prices get up, we have to be watchful for demand destruction there?
Yeah, absolutely. So there's the 10% across the board tariffs, but when we're importing iPhones from China, the tariffs on those are going to be far higher, or any consumer electronics that we're importing from anywhere, which often does come from China. Those tariffs are going to be very significant and put the manufacturers and the brands in a tough spot of either absorbing the tariffs or raising prices very substantially, which will one way or another have a dampening effect on demand.
Do you think, Gil, we're talking kind of near to intermediate term effects here. Long term, do you think all this could result in what Trump really wants here, which is this ramp, this increase in domestic chip manufacturing?
Well, you just reported TSMC going to build more in here, going to partner with Intel to do it. That is what the administration wants. And this is something that's been in the work for a few years. But these are very long-term investments. These are investments that pay off over decades. And the administration needed to make it clear to these companies that this is the new regime and they need to start making more of their product in the United States. We're doing it for a variety of reasons. Many of them have to do with our national interest. And the administration had to make it clear this isn't going to change. And if you want to sell your semiconductor products in the United States, you need to make them in the United States. And that's why it's not a coincidence that we got that announcement today. And TSMC has been aggressively building out its capacity in the US. They're uniquely qualified to make these chips. It is very hard to do so. And the administration wants them to do that in the US.
I got to ask you, Gil, while I have you about NVIDIA, because I know you've been on the sidelines there. I'm looking at this chart, though, Gil. I mean, this stock has now been shelled. It's down almost 25% year to date. I'm curious, given that move, how does valuation look now, Gil, for NVIDIA?
Well, if you asked me a couple of days ago, I would have told you that it looks pretty balanced because the upside was pretty substantial. If you believe consensus estimates for next year and you put a historical multiple on that, the stock could go to 160. If you don't, if you think that CapEx is going to roll over this year and this is peak year, then and you put a lower end multiple on that, the stock could go to 80. And so as of a couple of days ago, that was a pretty balanced risk reward. But based on everything we just talked about, if I'm Microsoft, if I'm Google, if I'm Amazon, if I'm Meta, and I'm looking at my core product getting weaker, investors already being concerned at the rate I'm investing or over investing in CapEx, I would think that we need to revisit that CapEx outlook that just a few weeks ago looked set to be up 40, 50% over last year. I would think that as we hear from these companies, we're going to hear increasing caution about whether or not they're going to deploy all the data centers at the rates that they were previously planning to do.
Gil, we're always lucky to have you on the show. Thanks so much for joining us.
Thank you.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.